You have $10,000 to allocate in the vintage watch market, and you find yourself facing the definitive collector's dilemma, choosing between two of the most historically significant timepieces ever produced. In one corner is the Rolex Submariner Reference 5513. Rolex began manufacturing this watch in 1962 and didn't stop until 1989, resulting in a massive 27-year continuous production run. The 105012 was the exact reference strapped to astronaut wrists as they completed the demanding spacewalks that proved we could survive outside a capsule. Because of that rigorous testing, this specific reference became the direct predecessor to the watch worn on the lunar surface in 1969. So as an investor, you have to weigh two very different assets. You are choosing between the enduring global safety of Rolex's famous dive watch silhouette and the unrepeatable finite milestone of Omega's mid-century space program. Beyond their histories, the way these watches are built dictates entirely how collectors value them. Rolex equipped the 5513 with the caliber 1520 and later the 1530, two of the most robust time-only automatic movements the company ever designed. By skipping the date mechanism, Rolex created a highly legible, perfectly symmetrical dial. To this day, purists prefer the visual balance of this no-date layout over anything else in the catalog. Omega took a vastly different mechanical approach. Inside the 105.012 sits the caliber 321, a highly complex, incredibly revered column wheel chronograph movement. Here is where the market splits. Omega collectors will pay heavy premiums to secure that specific 321 movement, along with its correct asymmetric case pushers. Rolex collectors, meanwhile, base their premiums almost entirely on variations in dial text and patination. That means verifying an investment-grade Omega requires complex mechanical inspections and strict case condition checks. Investing in a Rolex 5513 is primarily an exercise in evaluating aesthetic dial rarity. History and mechanics matter, but to understand future value, we need to look at the first major financial market force driving these assets: structural supply. This bar chart shows the stark reality of their production volumes. Estimates suggest that well over 300,000 Rolex 5513 examples left the factory during its run. That high market saturation establishes a natural ceiling. With so many baseline examples in circulation, standard models face inherent limits on how fast and how high their prices can climb. By contrast, the Omega 105.012 suffers from a severe supply bottleneck. 3 years of production yields a fraction of the inventory, and the surviving inventory shrinks even further when you factor in collector demands. Buyers want specific, original physical traits, like the dot over 90 bezel and an untouched tritium dial. Locating those specific traits together in perfect original condition is almost as rare as the historical event the watch was built for. The math is straightforward. Rolexes are highly accessible. The Omega's structural scarcity acts as an automatic, compounding driver for higher collector premiums over time. The second major force is liquidity. In the watch market, this means your ability to sell an asset quickly, globally, and at a standardized fair market price. Here, the Rolex Submariner absolutely dominates. It consistently ranks as the most searched vintage reference across every major secondary market platform today. Whether you are selling in Geneva, Tokyo, or New York, a standard Rolex 5513 needs absolutely zero introduction to a buyer. The market knows exactly what it is and what it is worth on any given Tuesday. The Omega 105.012 operates differently. To realize its true value, you need a highly educated, specialist buyer who understands the nuances of vintage chronographs and applied dial logos. Because that specific audience pool is much smaller, executing a high-value Omega sale simply takes longer. This comparison maps the trade-off directly. You have the Rolex sitting comfortably in the high-speed, low-expertise zone. The Omega sits squarely in the high-expertise, low-speed zone. If you need to liquidate quickly, the Rolex functions like a cash equivalent. The Omega requires a patient exit strategy to extract your maximum financial return. Ultimately, every investor wants to look at the scoreboard. So let's examine the 10-year historical price appreciation data for both pieces. This graph tracks a standard Rolex 5513. A decade ago, baseline examples traded in the $3,000 range. Today, those same watches command roughly $15,000. The Omega 105.012 shows a nearly identical trajectory. 10 years ago, you could acquire one for $2,000. Today, a clean example reaches $18,000. Both assets reliably tripled in value. However, there is a clear deviation for the Omega. When an example surfaces with documented NASA provenance, it routinely breaks the trend, causing isolated market spikes that push well into six-figure territory at auction. Both watches offer excellent, reliable baseline returns. But if historical provenance can be proven, the Omega possesses a mathematically higher ceiling. Making your decision isn't about finding the single best watch. It's about mapping these assets against your specific risk profile. First, we have the exit speed investor. You prioritize safety, universal global recognition, and the peace of mind that comes from knowing you can liquidate instantly if market conditions shift. For that profile, the Rolex 5513 is the clear choice. It is the definitive blue-chip equity of the vintage watch market. Then we have the historical yield investor. You don't mind tying up capital for longer periods. You prioritize finite scarcity and an irreplaceable narrative over the convenience of a quick sale. If that sounds like you, the Omega 105.012 is your target. It acts as a rare historical bond, paying its yield through long-term narrative value. Looking at current market trends, the available pool of investment-grade Omegas continues to shrink while global demand grows. That dynamic suggests the Omega's future appreciation will likely accelerate at a disproportionate rate compared to the wider market. Of course, the most sophisticated players in the market don't limit themselves to just one profile. They choose to hold both assets simultaneously to balance out their vintage portfolios. Because at the end of the day, these two titans do not actually compete with one another. In a mature investment strategy, they perfectly complement each other.